Andrew, your idea of short term is 3 years. For those that can't get out there, how do they get the courage to invest, forgetting about 1 week or 1 year action, and say, I want to invest for 3 years so I can get a 93 percentile like Andrew Slimmon?
Well, I mean, look, from a market standpoint, when the market's down 20%, you look out 3 years, the returns are phenomenal. And I think that's what people are missing when people say recession, no recession. I say market's down 24%. We've built in a lot of bad news here.
Right.
And then from getting to a high percentile, when the market's down 24%, you can't go buy defensive stocks. You have to start looking for good quality companies that are down more than that. And I just think there are a lot of companies down 40, 50, 60%. And that's embedded a lot of bad news into their stock prices.
Yeah. Nobody from Morgan Stanley's watching this morning, Andrew. Give me some names.
Well, I think the consumer discretion. I mean, look, University of Michigan consumer sentiment is at a 44-year low. You all have to think about which is the direction of change. And at that level, it's so bad that eventually it's going to improve. And I think gas prices coming down, optimism is going to improve. And when I think about where are stocks reflecting that very low sentiment, it's in the consumer area, home apparel, home furnishing, home retail, home builders. Those stocks have been crushed. And I think that's very, very attractive. And usually when I mention stocks like that, people tell me all the reasons why they're down already by that amount. And I think you just have to think things could get better from here. They priced in a lot of bad news.
So you have to think things could get better from here, but isn't the conversation we're having on the economic growth front that things are going to get worse, that we're going to slow as the Fed tightens?
It's like Brammo.
No question. No question. Look, and at the market level, there's a battle going on. On the one hand, the bar was so low going into this earnings season. I mean, Tom Cayley, how many strategists have come on your show and said guidance is going to be lower? I mean, everyone expected a bad earnings season. So the setup was deliciously wonderful for, beating a low bar. That's the good news. The bad news is the Fed's not done raising rates. And I think we can't be too optimistic at the market level for that reason. But when you start to search for stocks, which is what I do, there are a lot of stocks down a lot more than the market. And I think there's a lot of quality stocks down a lot more than the market.
Well, Andrew, you talk about how everyone's expectation seems to be that guidance is going to be disappointing. It also seems that there's a lot of cohesion around the idea that the dollar is going to be a big theme as well this earnings season. We've already seen it, a warning from Microsoft. We saw it show up in IBM and J&J results yesterday. How large a headwind really is the dollar's strength that has faded over the last few days?
Yeah. So look, number one is there's really no evidence that when the dollar goes up a lot, it leads to weak stock market over time. There's really no evidence. In fact, if you look at the last 10 times the market's up over the dollar's up over 10% in a year, the market's actually higher 3-6 months later. So there's no evidence of that. But and I think the reason for that is a lot of times the stock market says, well, it's the dollar, and the market looks through that dollar weakness because the dollar gyrates. It's incredibly difficult to call the market based on, where your perceptions of where the dollar is going. So I just wouldn't do that, other than the extent I think you have to think about going into earnings season, how weak have stocks been and how low is the bar? And right now the bar is really, really low. So I think what you're going to see is some of these companies are going to say, earnings aren't great because the dollar's too strong. And I question whether the stocks are going to go down on that because a lot of that's already embedded in their stock prices.
Do we need a catharsis? I mean, it's as simple as that. The Bear Crew saying we've got to get out VIX 40, catharsis, Andrew Slimmon, ages, grays further, et cetera. Do we need that?
Yeah, I mean, that is a very good point, Tom, which is usually when you have these types of sell-offs, they end in some cathartic event or some type of bad financial, I hate to say it, but somebody floats to the surface. And what's happening in cryptocurrency and some of these vendors, is that enough It's hard to think that's the case. So again, I do go back to this. I'm just not sure. I think the market's in a kind of in a standing mode where on one hand, again, earnings are okay, but on the other hand, the Fed's tightening, and usually that lows end in some cathartic event. Maybe that happens, early this fall. I still think the market will be substantially higher by year end, but I just think it's too soon to get too optimistic at the market level.
Andrew, I swear that you were definitively bearish the last time we caught up. Is something starting to change here for you?
Well, I think what's changed is that everyone thinks earnings are going to be horrible. I mean, the one side of the boat is so crowded. Guidance is earnings are expected to be so weak that I think that presents a very intriguing opportunity. And the other thing is, I'm always very nervous. I mean, I've been on this show. I'm always nervous going into the summer. Bad things happen to the market in the summer. And I think, we're into earnings season. We're getting a lift out of earnings season, but the Fed's going to raise rates. And what's going to happen next month? It's all going to be about how many more times the Fed's raising rates. And that gets me nervous. Anytime the conversation pivots from individual stocks, which is what we're doing right now, to the market overall, I think the market becomes more vulnerable.